Hey friend, have you ever thought about this? In the next 10 years, the biggest players in crypto might not be people like you and me anymore. It could actually be Wall Street's pension money. Sounds kinda absurd, right? After all, in most people's minds, Bitcoin and Ethereum are just speculative games for young folks, toys for geeks, or chips for gamblers and trading groups. But here's what you need to know. The US pension market is worth more than $12.5 trillion. If even just 1% of that slowly flows into crypto, that's $125 billion of new money. Friends, that number would literally raise the entire water level of the crypto market. Imagine this. If you add 1 extra meter of water to a swimming pool, people who could once stand at the bottom now have to swim hard. But for those who already know how to swim, that's a brand new opportunity. In the past, Bitcoin and Ethereum's rallies relied mostly on who? On retail enthusiasm. Back in 2021, the madness of NFTs, DeFi, and the metaverse pushed Bitcoin to $69,000 and Ethereum close to $4,300. Some people hit financial freedom in that wave, but way more got trapped buying the top and ended up stuck for years. Back then, the rhythm of the market was hot money rushes and everyone follows bubble burst panic exits. It was like a casino party, fun but brutal. But this year, things are totally different. Because pensions, the largest long-term capital pool in the world, are now being allowed into the market. So what does that mean? It means retail investors are no longer the only stars of the show. From now on, the market will likely be led by massive funds with decades or even 100-year horizons. Which raises the big question. What should retail investors do? Are we going to get pushed aside completely? Or can we actually ride this tide and find new opportunities? Hi, I'm Daryl Hart, a blogger who loves gossiping about finance. Today, let's break down 3 key questions. 1. Why are pensions starting to buy Bitcoin? 2. What kind of deep impact will this money have on the market? 3. And how should regular retail investors adjust their strategies? 1. Why are pensions looking at crypto? The logic is actually super simple: to fight inflation. Pension money has extremely long time horizons, sometimes spanning decades. What they fear most is inflation. Imagine this: you have $1 million today, put it into bonds earning 2% a year. 20 years later, maybe you've got $1.5 million on paper, but in terms of real purchasing power, maybe it's not even worth half of what you had today. Pensions need to support tens of millions, even hundreds of millions of retirees. They have to find assets that can beat inflation. For decades, pensions mainly allocated to stocks and bonds. But here's the problem. Bond yields have been stuck low for years, and stock valuations are sky high. What do? They need new growth points. And Bitcoin and Ethereum? Over the past 10 years, they've outperformed most traditional assets. Pull up any chart, Bitcoin's up over 10,000x in a decade. Yes, the ride is crazy in the short term, but zoom out, and it's crushed gold, real estate, even the US stock market. And what really gave pensions the courage to step in? ETF. In the past, institutions didn't avoid Bitcoin because they didn't like it. It's because they literally couldn't buy it. Custody risks were huge, compliance issues everywhere, risk management couldn't pass it. But ETF solved all that. Buying a Bitcoin ETF is as easy as buying an Apple stock fund. Legal, compliant, safe. So pensions entering crypto isn't some impulsive decision. It's the result of a systemic shift. To Wall Street's nose for trends. You know who's got the sharpest nose for money? Wall Street. In 2023, BlackRock, the world's largest asset manager, officially filed for a Bitcoin Spot ETF. They manage $9 trillion. If they push something, you can bet it's backed by serious strategy. Then came Fidelity, Vanguard, and other giants. And remember, these are the ultra-conservative players. The ones who used to stick to blue-chip stocks and government bonds. But now, they're adding Bitcoin. What does that tell us? It means Bitcoin is shifting from being seen as a speculative asset to becoming a strategic asset. And just look at the media narrative. A few years ago, the Wall Street Journal and the New York Times were constantly trashing Bitcoin, calling it a scam, saying it would go to zero. But in the past 2 years, they've started calmly discussing whether pensions should buy some. Whether digital gold has real value. Friend, think carefully. That change in attitude itself is a massive signal. 3. What makes pension money different? So what's so special about pension money? First, long term. Retail investors might buy Bitcoin today, see it drop 10% tomorrow, and panic sell. Pensions don't do that. Once they buy, they hold for 10, 20 years or longer. That kind of long-term money massively reduces volatility. Second, diversified allocation. The typical U.S. pension mix is 60% stocks, 30% bonds, 10% alternative assets. Crypto will almost certainly go into that alternative bucket. At first, maybe just 1%. But remember, 1% of $12.5 trillion is still $125 billion. That's like pouring concrete under the market floor, making the foundation much stronger. Third, structural impact. Pension money isn't here to gamble. It's here to reshape the market structure. Picture this. Before, the market was full of motorcycles zooming around. Suddenly, a bunch of trucks roll in. They're slower but heavier, and they change the whole traffic system. For the three-stage rocket model. Now, let's talk about a super important concept, the three-stage rocket model. Every single crypto bull market has followed this pattern. Stage 1, Bitcoin. It's the ignition. Nothing takes off without Bitcoin. Institutions and pensions will always start with it. Biggest market cap, strongest narrative, most regulatory clarity. Stage 2, Ethereum. It represents ecosystem expansion. Ethereum still has the most developers, the widest adoption. And it's got staking yields. For long-term capital, that's like buying a growth stock that also pays interest. Very attractive. Stage 3, new sectors. This is where retail investors can shine. Every bull run brings a new story. In 2017, it was ICOs. In 2021, it was DeFi and NFTs. What's next? Very likely AI plus crypto or RWA, real-world assets on-chain. Think about it, your future paycheck could be a token on-chain. Your house deed, your bonds, even your gold could be digitized and traded instantly. That's the power of RWA. And AI combined with crypto could spark brand new applications. 5. So do retail investors still have a chance? A lot of people are probably wondering, does this mean retail investors are finished? Actually, it's the opposite. Retail still has opportunities, maybe even bigger than before. Why? Because retail is flexible. Big funds need processes, compliance, slow building. Retail can buy today, act tomorrow. The key is start thinking like institutions. First, build in batches. Pensions never buy all at once. They dollar cost average. Retail should too. Don't go all in at once. Second, layered allocation. For example, 60% Bitcoin, your anchor. 30% Ethereum, your growth layer. 10% new sectors like AI plus crypto or RWA. That way you capture the overall market upside but still have moonshot potential. Third, long-term mindset. Don't get hyped over a 5% pump or panic over a 10% dip. Imagine you're a pension fund manager. Think in 5-10-year horizons. Take the global view. Finally, let's zoom out. In 2024, the US SEC approved spot Bitcoin ETFs. Huge deal. It means crypto has moved from the gray zone into mainstream finance. Hong Kong and Singapore are rolling out frameworks to compete as Asia's crypto hubs. Europe is exploring a digital euro. China is pushing the digital yuan. Here's a fun fact. Stablecoin transaction volume has already surpassed Visa's cross-border payments. This isn't the future, it's happening now. In some areas, blockchain is already ahead of traditional finance. In RWA, tokenized U.S. treasuries have already topped $1 billion. BlackRock, Franklin Templeton, they're all piling in. Put all these signs together, and the trend is crystal clear. Crypto is moving from the margins to the mainstream. So what we're witnessing isn't just another bull market, it's a financial system transformation. Pension money is entering. ETFs are open. Global regulation is shifting. Put it all together, and it means Bitcoin, Ethereum, and new crypto sectors are being officially pulled into the mainstream financial system. For retail investors, this could be the single biggest opportunity of the next decade. Because when a new asset class is just starting to get accepted by the top players, that's when ordinary people can still get in early. Once everyone accepts it, the only thing left might be scraps. So if you found this breakdown helpful, don't forget to hit like, that way I'll know to keep doing deep dives like this. Drop a comment too. Do you think pensions will make the market more stable or blow an even bigger bubble? And don't forget to hit that little bell. Next time I'll dive into new sectors and see which one has the best shot at becoming the next breakout.